Apple currently holds enough cash to cover a significant chunk of an entire mid-sized country's annual GDP. And yet, Apple borrows money, not once, repeatedly, billions of dollars in bonds, issued year after year, paying interest to investors around the world, while sitting on a cash pile large enough to buy out competitors, entire industries, maybe even a small nation, in cash. On the surface, this sounds insane. If you have the money, why borrow? Why pay interest? It goes against everything we're taught about personal finance. But this is exactly where everyday logic and corporate finance logic split apart. And once you understand what these companies are actually doing, you'll realize this isn't just an accounting trick, it's an entire system, a game that very few people understand, but one that quietly runs the global economy. And understanding the rules of this game matters because the 2008 financial crisis and the 2023 banking collapse both started with one wrong move in this exact same game. Over the past couple of years, you've probably seen headlines like Silicon Valley Bank collapses, corporate debt bubble, companies struggling to refinance. These are all symptoms of the same underlying story. From 2020 to 2021, interest rates were so low that borrowing money was almost free. Companies took full advantage, piling on trillions of dollars in debt simply because it was cheap. Then, in 2022 and 2023, interest rates shot upward. The same debt that was once cheap suddenly became expensive, and overnight, companies that looked wealthy on paper started struggling to survive. So the question is, if debt is this risky, why don't companies just avoid it, especially the ones who already have enormous cash reserves? To understand the answer, we need to grasp something most people never think about. For a corporation, having cash and being financially strong are two completely different things.
Step by step, how the system actually works. Let's break this down with a simple example. Imagine you run a small business. You have $100,000 sitting in the bank. A new machine comes along that would double your production, and it costs exactly $100,000. You have two options. 1. Pull out all your cash and buy the machine outright. 2. Take a bank loan at 8% interest and let your cash stay untouched in the bank. Most people would think, I have the cash, why pay interest on top of it? But a smart CFO thinks differently. They ask, if I invest this $100,000 back into the business myself, can it generate a return higher than 8%? If the answer is yes, taking the loan is the better move. You're using cheap capital, costing you 8%, to generate a higher return, say 15–20%. The difference becomes pure profit. In finance, this is called cost of capital. Every dollar has a cost, whether it's your own money or borrowed money. And smart companies are constantly comparing which source is cheaper. And here's where the twist completely changes the game. Interest on debt is tax deductible. This means when a company takes a loan and pays interest, that interest gets subtracted from their taxable income. The government is essentially subsidizing part of their loan, simply because they borrowed, instead of using their own cash. This is called a tax shield. So when companies like Apple, Google, or Microsoft take on debt, they aren't just borrowing money. They're taking a discount handed to them by the government, purely for choosing debt over their own reserves. Now pause and think about what this actually implies. The wealthier a company is, the stronger its incentive to borrow. Because with such massive tax bills, every dollar of interest deduction creates enormous value for them. In finance, this is called cost of capital. Every dollar has a cost, whether it's your own money or borrowed money. And smart companies are constantly comparing which source is cheaper. And here's where the twist completely changes the game. Interest on debt is tax deductible. This means when a company takes a loan and pays interest, that interest gets subtracted from their taxable income. The government is essentially subsidizing part of their loan, simply because they borrowed, instead of using their own cash. This is called a tax shield. So when companies like Apple, Google, or Microsoft take on debt, they aren't just borrowing money, they're taking a discount handed to them by the government, purely for choosing debt over their own reserves. Now pause and think about what this actually implies. The wealthier a company is, the stronger its incentive to borrow.
Because with such massive tax bills, every dollar of interest deduction creates enormous value for them. This is the exact opposite of what our intuition tells us. The uncomfortable math. But this isn't just about tax. There's another mechanism at play here that matters even more to companies: leverage. Picture a company worth $100 million, built entirely from its own equity. If the company grows 10%, your return is 10%. Now imagine you invested $50 million of your own money and borrowed the other $50 million. The company is still worth $100 million, and it still grows 10%. That's $10 million in profit. But now that $10 million is divided only across your $50 million in equity, not the full $100 million. Your return just became 20%, simply because you used less of your own money and amplified your return using borrowed capital. This is called financial leverage. It's the exact same principle Wall Street, private equity firms, and real estate investors have used for decades. More debt means more amplification, whether it's profit or loss. And this is exactly where things turn dangerous. Because leverage doesn't just amplify profits, it amplifies losses with equal force. The 2008 financial crisis was this exact mechanism, taken to an extreme. Banks had leveraged themselves 30 to 40 times their actual capital in some cases. So when the housing market cracked even slightly, the entire system collapsed. One small fracture and the whole structure came down. So when companies take on debt, they're essentially making a calculated bet. We can manage the risk that comes with this leverage because the upside is worth it. But that bet doesn't always pay off. Hype versus reality, the contrast. Here's something Wall Street's narrative conveniently glosses over. In earnings calls and press releases, you'll hear phrases like, "We're optimizing our capital structure," "We're using debt strategically," "We're maximizing shareholder value." It all sounds remarkably intelligent, but in reality, a large chunk of this borrowed money goes towards something far less glamorous: stock buybacks. Instead of using their own free cash, companies take cheap debt and use it to buy back their own shares. This shrinks the number of shares outstanding, boosts earnings per share, pushes the stock price up, and conveniently inflates executive stock-based bonuses along the way. Apple alone has spent over $600 billion on buybacks over the past decade, a significant portion of it funded through debt. This raises an uncomfortable question. Is this really smart capital allocation, or is it an engineered illusion that artificially inflates stock price without actually expanding the company's real productive capacity? Because when a company borrows money to buy back its own stock, it isn't building a new factory. It isn't launching a new product. It isn't creating new jobs. It's simply engineering its balance sheet to make the numbers look good. And when interest rates rise, as they did in 2022 and 2023, that same debt, once considered a smart move, suddenly becomes a burden. Companies are forced to refinance existing debt at higher rates, and the same cash flow that once fueled growth now goes towards simply covering interest payments. Boeing is a real-world example of exactly this. For years, the company funneled a huge share of its cash flow into buybacks and dividends while underinvesting in its own engineering and safety infrastructure. When the 737 MAX crisis hit, its balance sheet was already so stretched that it had to take on tens of billions in emergency debt, not to grow, but just to survive. Now let's zoom out further. If the world's largest companies, worth trillions of dollars combined, depend on debt to this degree for growth and survival, it means the global economy itself is built on top of this same dependency. When central banks raise or lower interest rates, they're not just affecting your home loan, they're directly deciding how the most powerful companies on the planet manage their money. Between 2020 and 2021, when rates hovered near zero, companies borrowed trillions of dollars at historically cheap rates. This period was so unusual that economists call it the era of free money. But every free lunch eventually comes with a bill.
When the Federal Reserve rapidly raised rates in 2022 to fight inflation, the same companies that had been surviving on cheap debt suddenly had to pay multiples more in interest. The greatest risk falls on what economists call zombie companies, businesses so deep in debt that their entire annual profit barely covers the interest on their loans. They can't grow, they can't hire, they can't innovate. They're simply alive, kept afloat artificially by cheap debt. Estimates suggest thousands of such companies exist globally, surviving purely because interest rates were low. The moment rates rise, these companies begin collapsing one after another. And this is exactly where this story connects back to you and me. When large corporations collapse under the weight of their own debt, the impact doesn't stay contained to shareholders. Jobs disappear. Supply chains break down. The banks that lent them money take losses too. And those losses eventually trickle down to people like us through higher prices, layoffs, and economic slowdowns. So a strategy that once looked like smart financial engineering becomes, when taken too far, a systemic risk to the entire economy.
So let's return to the original question. If a company has enough money to buy anything outright in cash, why borrow at all? The answer is, in modern capitalism, being rich and being financially optimal are two entirely different things. Companies don't borrow because they need to. They borrow because the system rewards them for doing so, through tax benefits, through leverage, through stock price gains. But every system that rewards risk-taking eventually collects on that risk. And here's a question no economist can confidently answer. If the world's most powerful companies need to borrow money just to project financial strength, was that strength ever real to begin with? Or are we all, investors, employees, consumers, living inside an economy that doesn't run on cash, but on confidence? And the day that confidence breaks, what happens then?